Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today we're going to be doing a little case study / analysis of General Electric. This one came in by request down in the comment section of one of my other videos. If you have a request of a stock you'd like me to analyze, just drop it down in the comment section. I'll get the ticker on the whiteboard behind me and eventually I will make a video. The stocks that are in the S&P 500 like General Electric, I post those videos on YouTube for free. The rest I post on Patreon, which is $5 a month, and in the full Cyclical Investors Club service on Seeking Alpha. Those links will be down in the description. And if you join Patreon, you can get a big discount if you ever decide to join the full Cyclical Investors Club service, where you'll see me using a lot of the spreadsheets. I don't know if I'm going to use any in this video. But there's chat room where you can chat with me. I have dozens of articles and strategies that I don't share. I don't have dozens of strategies, but I have dozens of articles and a few strategies that I don't share with the public that are exclusive to the service. There's also a discount code for Fast Graphs, which you'll see me using here in the description for 25% off if you decide you kind of like how it works. I've been using it about 5 years now, and I get a little bit of a commission for people that join Fast Graphs through that link, so it's a good way to support the channel if it's something you think you might be interested in anyway. All right, so getting into General Electric. As always, this isn't individual investing advice. This is just how I analyze stocks. I think I'm going to put this in my case study playlist because it shows that how to look for businesses that are being disrupted, whose market is shrinking, and who isn't really able to grow anymore. So the background on General Electric, for those that don't know, this was one of the best stocks to invest in, if not the best. Berkshire might have given them a run for their money up until the late 90s and into 2000 at the peak, which isn't on this graph because it goes back 20 years and the peak is now hard to believe it was more than 20 years ago. I don't know how many tens of thousands of percent a person would have made in General Electric stock if they would have owned it in the 20 or 30 years leading up to 2000, but it was a lot. And it basically got ridiculously overvalued during the dot-com boom, which actually had a lot of other high-quality stocks like get really overvalued, like Coca-Cola, McDonald's, which ended up falling 80%, General Electric. Some of these companies people thought were safe and who had a long, this is going to sound familiar, so I think it's a good story to tell when we think about the Magnificent Three or whatever it's down to, that have had returns to go well for a very long time now. And people, I think what happens is you build an investor base that becomes really comfortable with just holding the stock no matter what because they've done so well with it over the years, and they basically kind of just give up on the idea of ever taking profits in the stock when you're up like 1,000% or 10,000%. I think it's just collected investors over the years that totally believe in it. I think that's really what General Electric did. We probably see that with a few stocks nowadays too. But ultimately, there's a size where they just can't grow anymore. It becomes difficult to grow. And I think that's part of what happened to General Electric, but it happens to pretty much every business at some point. You have to be pretty special, like a Berkshire Hathaway, where you can buy different types of businesses and grow that way. And also be extremely well managed. So the number one metric that I watch out for when I'm trying to identify a stock that has a high potential of kind of plateauing and kind of reaching, if not a permanent high, a pretty long-term kind of plateau where there just isn't likely to be growth anymore. And that metric is a 3-year revenue trend. Now, this can be thrown off by M&A and things like that, so you want to keep an eye out for that as well. But if a business's revenue, like as big as General Electric is, if its revenue's lower 3 years from now than it is now, that's a sign that growth is pretty much done, or it's a good early warning signal that the odds are high that that's the case. I've tested this with a lot of stocks, and there are some that kind of buck the trend, but 9 out of 10 times it's probably going to be right eventually over time. Unless it's like during a recession. So I wouldn't use that metric during the Great Recession here, and because almost every company, especially an industrial business like General Electric and financial business like they were, is going to experience revenue decline in a recession. It's when you're not in a recession, if you're mid-cycle or even late cycle, and the revenues are lower than they were 3 years ago, that is almost always a hardcore sell for me, unless there's a very clear explanation for it. And I don't think I've ever regretted selling a stock. Some of them for that reason. Some of them can hang in there for a while and maybe even go higher for a little while. But the odds of them really giving you good returns over the medium term, 3-5 years or more, are pretty low. So I bring that up because that's the main thing that I would focus this like case study on. And the first point where General Electric hit that was in 2004, right around here. And there was maybe a year or so where that was the case. It didn't last very long, and then they started to recover. So I could kind of forgive somebody if they owned this stock at this time, and they were just kind of waiting to see for sure. And then, as you can see, earnings started to pick up, and things started to improve, right? So I think it's it's forgivable to hang on maybe to General Electric during this particular time. It wasn't a totally clear signal, and then we had a recession. So you can't really blame them on the recession. They had a giant price decline, and earnings decline during the recession. Probably exposed a lot of weaknesses. Yeah, down 80%, more than 80%. And it hadn't reached its all-time high again even before that. It was higher in 2000. So this has been a long cascading decline of earnings and price for quite a while. And then, so if a person wanted to bottom pick this at some point at this time, I mean, maybe. I mean, that might have been all right. I didn't do it. But when we got up to this point in about 2014 and 2015, we also, revenues, which you can't see on this graph, but because this dark shaded area is earnings. But revenues continued to kind of come down. They came down in the recession, which is understandable. And then they kind of bounced for a second, and then they were continued down again. And they started continuing down right here. Now, it could be because General Electric was selling off some of its businesses. And when you're selling off some of your businesses to kind of get more efficient or whatever, revenues will go down, but it might improve your company over the long run. But the key point is they aren't growing, right? They aren't growing their business. So the odds of the future returns growing are low. So for me, especially, I mean, it was still trading at even before earnings fell here, at like a 15 or 16 PE. Well, that's a normal PE for a shrinking business. So that doesn't make any sense to me. We also saw earnings per share fall. So we really kind of saw everything here in these couple years where I think investors, these are the guys that really got it wrong, I think. I think they were looking more at the price recovery that had been steadily happening. And off the bottom, it would have been great. So all the people that owned it here would have been up, 100% or something. And I would have definitely sold during this time period. Like 2014 to 2015 was pretty clear sell signal to me. And then we got what usually happens when businesses start shrinking. So without getting into all the details, especially on a giant conglomerate like General Electric had become, and who knew what their finances were. I used to just look at this and I'd read articles, a little bit of them sometimes, and I'd be like, nobody understands what's going on. It's better just to admit you don't understand and go find something else that's has better prospects, right? So the rule here is if revenues are lower than they were 3 years ago, and there's not like a recession or like an easy explanation, that is a sell in my book. Go find something that's growing, because the whole point of owning stocks is that they can raise earnings if inflation at faster than inflation, basically. Um, we don't live in an age, I don't think, anymore like in 1950s where there are really serious asset plays for just individual stock investors. It's pretty much impossible, I think, for an individual investor to go out, find a stock that's trading super cheap where its assets are worth more than its stock price and like nets and things. They don't really exist in a practical way, if you ask me. And it's not something I would have an edge at, even if they did exist. So that's the main kind of case study rule that I would take away from this. The other one is, and I already made a video on this, about investing in turnarounds. This business has been a turnaround business for the past 20 years. Okay, so this shows you how hard it is and how many false starts there could be. There's already been one drop before this 20-year time period begins, and then there's another drop, and then a struggle, and then another drop. Okay, and then a struggle, and then another drop. Okay, so now we're on the upside, and just to prove to everybody that I'm not like biased against General Electric, I think this could actually really be like a turnaround. Like, it could be the time finally. Now, I don't invest in turnarounds, so I'm not going to do it, but I'm willing to accept that it could happen, right? And at least now we're in a period where they've kind of pared down enough stuff where maybe what's left could actually turn around. So what I'm going to do now is just without getting into the business details, just kind of do a little mental calculation, back of the envelope type of a thing, just to see if it's reasonable for someone buying the stock now. I mean, it does trade at like a 46 PE, but earnings are expected to really rise a lot. So if they actually do this, then maybe that makes sense. But the first thing I would do is I would go and look at, and they may have sold off one other part of their business since 2020. I can't remember. I don't really follow the news on these guys because I know I'm not going to buy them. But I would look at the earnings right for 2019. Okay, we have $4 in earnings. We've had at least 20% inflation right since then, probably more like 25 by the time we get into next year. So all else being equal, if we just forgot about the COVID, forgot about whatever other junk happened, and you said, okay, they can probably recover soon to where they were before the pandemic, right? I think that's a reasonable assumption for an investor to kind of make. That would be about, plus if we just add inflation to that, that's like, we'll call it $5 a share, maybe a little more than $5 a share. So analysts are expecting 455 this year. So that's reasonable. I mean, really, they're just trying to recover earnings that they had before the pandemic, plus the inflation we've had since the pandemic. So this doesn't seem like crazy to me and that it's a big jump, obviously 62% growth, but it doesn't seem outlandish to me that could happen, right? I mean, I would even say $5 probably makes more sense. So if you go out another year to $6 and you say, okay, if they keep that momentum rolling, there isn't a recession and nothing else comes up. I mean, this is not a crazy like earnings assumption, and it's 100% higher than this year. So if you divide 26 by half, you're down to 23, and you're at a market multiple. Now it's an expensive market multiple, but at first glance, someone could say this looks like super expensive, but I think it probably looks about the same as the rest of the market, honestly, assuming that they can actually carry through this recovery. This recovery, I don't think of necessarily as a turnaround. I think of it as just a recovery from all the COVID stuff that happened, and I'm sure there were other things that were going on, but it's just perfectly reasonable to think that they could, after 6 years or 5 years, recover from this big giant COVID decline, and then get a little inflation on top of that. There's plenty of time for them to be able to do that. So to me, I think this, again, just roughly speaking, like this $6 earnings in 2025 seems reasonable. Now, what's tricky is after that, and actually analysts have earnings growth dropping quite a bit compared to, it's cutting by half each year. So they're just making this stuff up. But it's made up in a reasonable way, I think, at least right now. So after this, I wouldn't be pricing in 100% growth every 2 years or whatever. I'm not sure about that. But if we can go to the Fast Graphs forecasting calculator, and what I would say is I would just put, honestly, well, if the momentum continues, the multiple will probably trade higher. But for me, like a 21 multiple, assuming there's not a recession, maybe a 24 would be reasonable in 2 years. Okay, if they can hit the $6 a share, $5.99 in earnings a share. So we can go on the Fast Graph and we can look at that. I can actually enter my own multiples here, but they have enough of them. I don't think I need to. Like the market's probably about 21 right now anyway. So this would be today's multiple. So we avoid recession. General Electric basically recovers to where it was pre-pandemic. That's would be the thesis here. And the market stays valued kind of where it's at now. So maybe there's an interest rate thing and inflation thing that you have to think about as well. But basically, if we go here at a 21 multiple, they get the double in earnings growth. And you're looking at $126 per share. So that's a little lower than where it is right now. But at 24 multiple, we're looking at 144 a share, we'll call it. So right in the middle of those, 21 to 24 is probably maybe the range we might be thinking. That's where the stock price basically is today. So I would say, while I don't know how to really value this, because one, I don't know what earnings growth is going to be after this. Two, it could be cyclical still. I think it'd probably be less cyclical than it was before, but if there is a recession, we don't know what these earnings are going to do. We don't know how far they could fall again. So there's just a lot of unknowns, and I wouldn't really know how to even take a stab at guessing that. I mean, a person would have to do a much deeper research to come up with like a good estimate, I think. So yeah, right now relative to the market, I would say General Electric is fairly valued, but that also means like if a person's buying it here and it reverts to a normal multiple, that their stock is going nowhere for 2 years. So I don't think there's really much upside. And then, that doesn't mean the price couldn't keep going up as long as if they hit all these earnings and everything. But at some point, the price will kind of level off and come back down. They'll probably have a time in a year where they beat earnings and the guidance is normal and they guide to maybe even exactly where we're at here, but the market just sells off the stock. So because kind of the smart money is getting out early before, because they know it will revert if all this stuff comes true. They'll know it revert down to a 24 or 21 PE eventually. But the momentum guys and everybody will ride this as long as they can. And then sort of magic, if you're watching the news, if you're just watching like the earnings news, it'll be like a good report and it'll sell off. And people will be like, what the heck is going on? Well, they're getting out early because they know eventually that these earnings growth is probably going to, well, they don't know, but their play is they'll eventually level off once this recovery is over, or the valuation will come down. Because they know they're not going to grow at 60% a year for 10 years or something like that. So I would say there's 2 lessons from General Electric, at least. 1, maybe 3. First one, watch the revenue, the 3-year revenue number. Second one, be very careful about investing in turnarounds. They can even look good for a while. We had 1, 2, I would even call this a third false start. Before we get to where we are now. And that's over the course of 2 decades. It's a long time to have your money just slowly being eaten away. I think with the dividend, it's 22% off its high. Without the dividend, it's 62% off its high right now. So those are the 2 main things I would say. I have a whole video on the turnaround stuff. Now, the third one would be just about the forward earnings. Don't extrapolate out this next year if they do hit these earnings 5 more years, because it's highly unlikely, I would say, that you get that kind of rapid earnings recovery. Like I said, 1 out of 10 times maybe they do happen, but I'm a person that tries to kind of play the odds, and I know I'm not smart enough to pick the one that's gonna be the one that's not that's gonna like be awesome. Okay, hopefully you guys found this useful. If you did, hit the subscribe button. That fast graph link is down in the description, and if you have a request, drop it in the comment section, and I'll see everybody in the next video. Later.